Welcome back to the deep dive. Today we are really diving into the single biggest story in DeFi right now in 2025.
Yeah,
That's the massive, and it seems like accelerating token buyback boom.
it really is everywhere.
It feels like every successful protocol, derivative exchanges, lending platforms, they're all running their own sort of crypto version of a corporate stock buyback.
It's a huge trend, no denying it. And the scale is, well, it's kind of staggering when you look at the numbers.
Right.
Yeah, when we dug into the sources you sent over, the data shows that just 10 projects, literally 10, account for something like 92% of all the buyback spending this year.
92%.
Yep, we're talking over $1.4 billion worth of crypto is just pulled off the market systematically in just months.
Wow. Okay, so that number, $1.4 billion, it immediately brings up the big question, right? The one we really need to unpack in this deep dive. Is all this treasury money flowing out? Is it actually creating real sustainable value for the token holders? Is it, fitting with the whole decentralization idea?
Or is it something else?
Exactly. Or is it more like slick financial engineering? One source had this great phrase, didn't they? Centralized optics in decentralized clothing.
That really captures the tension, I think. And to figure that out, we probably need to start with who's actually driving this, the leaders. Because the market is, well, it's incredibly concentrated.
Okay, so who's at the top?
Well, when you look at the spending charts, one name just completely overshadows the rest. Hyperliquid.
Their dominances. Yeah, it's almost hard to believe.
It is. They're responsible for a massive $644 million in buybacks. Just them. That's nearly half the entire market share for this whole trend.
$500 million.
And it's not like random bursts either. Their approach is very methodical. They're repurchasing, on average, about $65 million every single month.
And this isn't just random funds, is it? The sources mentioned it comes from a specific place.
Right, that's a key detail. It's funded through their assistance fund.
Okay, so for you listening, what exactly is this assistance fund? Is it just their treasury?
Yeah, essentially. That's a good way to think about it. In Hyperliquid's case, the assistance fund is basically their main treasury. It catches the protocol revenue, from trading fees mostly.
Got it.
And by funneling that revenue directly into these really consistent high-volume buybacks, they're effectively creating this permanent, predictable demand in the market for their token.
So it acts like a floor, almost.
Sort of, yeah. If you need a comparison, it really is like the crypto version of, say, Apple's stock buyback program.
Yeah.
Just running constantly, efficiently. They've already bought back about 2.1% of their total token supply doing this.
But wait, the fact that one single project is responsible for almost $500 million in spending,
Yeah.
doesn't that kind of push back against the whole decentralization argument right there?
It absolutely does.
I mean, if the whole narrative hinges on how one entity manages its treasury, that feels pretty centralized, even if it's a DAO making the call.
It really highlights the core conflict. You're right. That level of market impact inevitably needs some kind of centralized decision-making, or at least coordination. But, not every project is following that exact playbook.
Okay.
If you look further down the list, you see different approaches. And that variety kind of underscores the difference between maybe strategic value creation and, well, just market signaling.
Like Layer 0, ZRO, they're high up there too. $150 million spent, covering about 5% of their supply.
Yes, but the context there is really important. That was a one-off move. It wasn't an ongoing program like Hyperliquid's. It was specifically aimed at early investors, basically providing a big liquidity event for them.
Ah, okay. So not about managing long-term supply dynamics in the same way.
Exactly. And then you've got the really interesting, maybe slightly painful case of Pump.Fun.
Oh, yeah. Tell us about that one.
They spent a hefty $138 million buying back about 3% of their supply. But here's the kicker, and this is really fascinating for you listening. The sources show that their token is actually trading below the average price they paid for those buybacks.
Ouch. So they're underwater on their own buybacks.
On paper, yes. They're sitting on a pretty considerable paper loss right now.
Wow.
And that situation just immediately throws cold water on the idea that, discretionary buybacks are some magic bullet for market volatility or a guaranteed way to pump the price.
Right. It shows the risk. You can't just fight the market manually all the time.
Exactly. It shows the risk and maybe the failure of trying to, manually manage market perception against just organic supply and demand.
Okay, so with all these different methods and outcomes, we probably need to pause and get really clear on the terms. We keep saying buyback. But there are two main ways this happens, right?
Absolutely crucial distinction. First, you have standard buybacks. That's where the tokens are repurchased, usually using protocol revenue, and then they're held, maybe in a treasury, maybe in a reserve.
So they're off the market, but not gone forever.
Right. They could potentially be redistributed later. And that's the risk, isn't it? The supply reduction is only temporary.
Which means, down the line, some treasury decision could actually dilute everyone again if those tokens get used for grants or just released back out.
Precisely. Then you have the second way, buy and burn.
Okay.
This is where tokens are bought back and then permanently removed, like deleted from the supply forever, usually via a smart contract that sends them to an unrecoverable address.
And we see projects really leaning into that.
Yeah, Redium on Solana is a big example here. They're kind of leading the buy and burn group. They've spent $100 million since 2022 specifically to permanently shrink their token supply.
So if the goal really is long-term scarcity, making the remaining tokens more valuable, the burn seems way more definitive than just holding them in a treasury where they might reappear later.
Unquestionably more effective for permanent supply reduction, yes. If we tie this back to that core conflict we mentioned.
Centralized optics versus real value.
Exactly. That distinction between buybacks, held, and buy and burns, deleted, is pretty essential to figure out if a protocol is genuinely committed to deflationary tokenomics, or if it's maybe just reserving that spending power for future needs, keeping its options open.
Okay, that makes sense. Let's dig into the why now. The economic logic behind this spending spree. Why this sudden boom in 2025? Is it just a marketing gimmick to prop up prices when things look shaky? Or is there a real rational economic strategy here?
Well, according to the sources we looked at, there seem to be two main drivers. First, there's the pretty practical function of price stabilization.
Okay.
Especially in protocols that have high token emissions, where new tokens are constantly hitting the market, buybacks can create some counter demand, sort of soak up that extra supply pressure.
Right, offsetting inflation, basically. And the second reason, this goes back to the critique, I bet.
It does. It's optics. Pure and simple. Exactly. It signals profitability. If your protocol can splash out hundreds of millions buying its own token back, it sends a pretty powerful message to the market, right?
Yeah. We're making money, we're doing well, and look, we're giving value back to you, the token holders.
That's the narrative. Returning value.
Okay, but this is where the big criticism really bites, especially when we talk about FDV, fully diluted valuation. Before we get into the critique itself, we need to make sure everyone listening understands this term. It's crucial. What is FDV and why does it matter so much here?
Right, good checkpoint. FDV, fully diluted valuation, is basically the total market value of a project if every single token that could ever possibly exist was actually out there trading right now.
So including tokens locked up for the team, for investors, tokens that haven't even been emitted yet, all of it.
All of it. It's the theoretical maximum value based on the total eventual supply.
So it's like pricing in the entire future potential today.
You got it. And the critique argues that many of these protocols doing huge buybacks, well, they still have incredibly high FDVs, massive valuations. But crucially, they often have very low circulating floats.
Meaning only a tiny percentage of the total potential tokens are actually trading day to day.
Exactly.
And that combination, high FDV, low float, that sounds like it could be easily manipulated, doesn't it?
That's the fear. If the protocol uses its revenue to buy back tokens, but it's only influencing that small circulating part, it could potentially maintain this huge overall valuation based mostly on tokens that aren't even really in play yet.
So the buyback isn't about decentralizing ownership or building utility.
Not necessarily. According to the critics, the revenue is being used primarily to manage the tokenomics, to control the perception of price, especially relative to that very high FDV.
And that's why the source material calls it borrowing Wall Street's playbook.
Precisely. It feels very much like traditional finance tactics.
Yeah, if these supposedly decentralized protocols are acting just like public companies, using financial tricks to manage their effective share price, well, it feels like a fundamental line is being crossed for Web3.
It does. The sources pretty bluntly call this trend the full financialization of decentralization.
Wow.
Yeah. These systems are borrowing sophisticated, established financial tools. And often, the argument goes, they're prioritizing that short-term price signal, managing the FDV, over the maybe harder, messier, longer-term work of actually achieving wide community ownership and governance.
That financialization angle makes a lot of sense, especially with the kind of money flying around. But okay, let's shift gears slightly. Let's look beyond just the biggest spenders like Hyperliquid's huge numbers and focus more on the approach, on efficiency.
Right.
Are there projects trying to prove buybacks can be done in a more decentralized way? Maybe through like programmatic methods where code dictates the buyback, not some committee meeting.
Yes, and that's a really important angle. There are outliers like GMX, Metaplex, Sky Protocol that offer a different perspective.
How so?
Well, they often show a higher percentage impact on their supply relative to their size, which suggests maybe a more effective link between the protocol's revenue and the token mechanism itself.
Okay, let's take GMX first. What are they doing?
So GMX has actually repurchased the highest share of its supply compared to anyone else, 12.9%.
Wow, nearly 13%. That's huge.
It's a massive chunk of the supply taken off the market. Now, it's important to remember, not all of that is necessarily burned forever.
Right, back to that distinction.
Exactly. But just the sheer proportion shows a really deep commitment to actively managing that circulating float.
Okay, and what about the smaller projects you mentioned, the ones focused on being programmatic?
Well, you have Metaplex, MPLX. They've bought back 6.5% of their supply. And importantly, the capital for that comes directly from DAO revenue. So it's clean, transparent, aligns incentives nicely.
And Sky Protocol, you said they were maybe the most interesting technically.
Yeah, Sky Protocol, SKY. They spent $78 million, which works out to about 5.4% of their supply. But the way they did it is key. They use a system of automated buybacks. It was specifically tied to surplus yield generated by the protocol. The automated part is the whole point here.
Okay, so it's not someone deciding, let's buy back now. The code just does it when the conditions are met.
Exactly. And that word automated, that really feels like the potential key to unlocking genuine decentralization in this context, doesn't it?
It does seem like it.
Yeah, these programmatic approaches, like what Sky Protocols is doing, they feel like a much clearer step towards true on-chain treasury governance. When the buyback is hard-coded, based on immutable metrics like yield or revenue, when the code has to execute the buyback.
It takes the human element, the potential for manipulation or just bad decisions, out of the loop.
Right. It removes that need for discretionary centralized decision-making, the kind that always leaves the door open for, market games or just simple human error.
So this really brings DeFi to a philosophical crossroads then. When it comes to buybacks, should the mechanism be automatic, baked into the core unchangeable logic of the protocol itself? Or should it stay discretionary? Needing a DAO vote or a committee sign-off, basically a corporate-style decision every time they want to spend that treasury money.
The sources we reviewed were pretty clear on their conclusion here. If genuine decentralization is the ultimate aim,
Automation has to win.
automation wins.
Oh.
The underlying ethos seems to favor code over committees. Think about it. A human team decided to spend $150 million feels very much like traditional finance, like financial engineering.
Right.
But code automatically executing a predefined mechanism triggered only by surplus revenue that the protocol itself generated. That feels much closer to a true self-sustaining financial organism.
That's a powerful distinction. That really is the future of protocol economics we need to keep an eye on.
Okay, so zooming back out for everyone listening,
Okay.
what does all this mean for right now, for the near future? We know these buybacks really took off since July 2025, and the whole space is going to blow past that $1.4 billion number soon. Well, this trend is definitely changing the whole market narrative.
Yeah.
It's become like the main way protocols are defending themselves against that criticism about high fully diluted valuations.
Oh, so.
They're basically using buybacks to signal confidence.
Yeah.
They're saying, look, we believe our future revenue will be strong enough to support this valuation, and we're willing to put our money where our mouth is by buying back tokens.
Mhm.
They're paying, sometimes dearly, for that signal.
So the whole blockchain economy is clearly shifting gears. We're
Right.
moving beyond just, hype tokens that relied on huge emissions and loud marketing
Right.
towards protocols that are trying, at least, to become these more complex, self-sustaining financial organisms, which means they need much more sophisticated internal economics, treasury management.
Absolutely. And it forces you, as someone involved in this space, whether you're investing or building or just participating, to really think about what the ultimate goal of these tools is.
Yeah.
Are buybacks going to become the reliable, maybe even programmed dividends of Web3? A systematic way to return real value to token holders that actually fits with that code as law idea.
That's the optimistic path.
That's the optimistic path. Or could they just be the next big speculative illusion? where protocols burn through hundreds of millions managing price optics today.
Only to dilute everyone later, or maybe just find out they can't actually sustain the profitability needed to keep that buyback engine running indefinitely.
Exactly. And that's really the question you need to keep mulling over as this trend continues to accelerate through the rest of 2025. Which path are we actually on?